the RBA cut interest rates unexpectedly and said the Aussie dollar remains overvalued. Dylan Eades from ANZ is on the line. Dylan, do you think this is the right decision to take?
Yeah, I mean, the tone of the RBA statement was certainly very dovish, with the bank noting its concern for underlying growth, particularly in relation to domestic demand. So I'd say that over the past sort of 8 to 9 weeks, which was when we had our last communications from the RBA, the bank has clearly made a pretty significant reassessment of its outlook and now expects growth to obviously continue at a below-trend pace for a longer period of time, and for the unemployment rate to peak at a higher rate as well. And so I think in conjunction with the global disinflationary pressures that we are seeing from lower oil prices and the like, it certainly does give the RBA scope to lower interest rates further to try and boost domestic demand. In particular, the RBA also seemed especially concerned about the decline in the terms of trade, so that's the lower commodity prices, particularly across iron ore, thermal and coking coal, which are our major exports, and the negative impact that they are having on income growth and also consumption within the economy as well. In terms of the currency, although we have seen the currency fall pretty sharply against the US dollar, on a trade-weighted basis, it still remains somewhat overvalued, particularly given the declines that we have seen in bulk commodity prices. And so the RBA is still very much of the view that the currency needs to fall a little bit further yet in order to try and, I suppose, assist rebalancing the economy away from mining to non-mining-led growth, which they are sort of still looking to occur. And at the moment, the currency, even though it has fallen, it still does remain overvalued on some metrics, and it is sort of, I suppose, hampering that transition at the moment. So I think the cut in the RBA policy was very much driven by a couple of factors. I think firstly to try and give a little bit more assistance to the domestic economy, but also very much done to try and push the currency a little bit lower as well. So it seems very much like an appropriate policy action for the time being.
And Dylan, how do you see the Aussie dollar performing against its major rivals in the near future?
Yeah, we still very much favour the Australian dollar lower against pretty much all the major currencies. So I think when you look at really what's driven the Aussie dollar over the past 2 to 3 years, when it has been significantly above its fair value, it's very much been driven by, one, that search for yield by global investors, and also because of Australia's positive growth dynamics as well. But we think that those factors which have really underpinned the Australian dollar have started to shift, and we expect that those drivers are going to continue to, or the change in the drivers for the Aussie dollar are going to continue to weigh on it over the next 12 to 18 months. So we think that the key drivers for the Aussie moving forward are really going to be the strengthening in the US dollar as the Fed continues to move towards its tightening cycle, and also the reform path that we are seeing in China, where we are seeing an ongoing deleveraging in the domestic property sector there, which is weighing on bulk commodity prices, and also the fact that they're trying to move that economy away from being an investment-driven economy towards one that's been much more consumption-driven, which is actually a negative for Australia and the Australian dollar more broadly. So we're looking for the Australian dollar to fall to around about 74 cents against the US dollar by the end of the year. And we are also expecting it to decline against both the euro and also sterling as well. In terms of the Kiwi, we think sort of Aussie Kiwi will sort of remain largely range-bound around that 103, 106 type mark moving forward.
And Dylan, staying on the topic of the Kiwi, it reached a 4-year low against the US dollar and gained against the Aussie dollar after the RBA cut its key interest rate. So Dylan, what did you think about this reaction? What sort of actions are you expecting from New Zealand's central bank?
So the RBNZ last week had their policy meeting, and while they didn't cut rates, they certainly adopted a much more dovish stance, I suppose. They removed the explicit tightening bias that they had in their language and adopted a very, very neutral bias in which they did note that the next move in rates could be up or down. At the moment, we think that the underlying prospects for the New Zealand economy, while they still remain reasonably solid, we do think that the case is certainly building there for rates to potentially move lower in New Zealand as well. And that's very much predicated on some of the global uncertainty that we are seeing, and also the fact that inflation remains very, very soft in the New Zealand economy at the moment. And the RBNZ, after all, is an inflation targeting bank. At the moment, we're still expecting the RBNZ to remain on hold for an extended period of time. But as I did say, the risks are certainly tilting towards the prospect for the next move being down. I think for you to see the RBNZ to cut rates again, though, you'd need to see the New Zealand dollar remain quite elevated, dairy prices to move lower or sideways rather than recover, and also for the Q1 inflation print, which is expected in a couple months' time to remain quite low as well. So I think if you had sort of one or two of those factors, if you had one or two of those factors to eventuate, such as if the New Zealand dollar remained high and inflation continued to soften, then that would probably provide scope for the RBNZ to potentially lower rates in New Zealand as well.
Dylan, thank you very much. It's been a pleasure. Well, viewers, do not go anywhere as we have plenty more heading your way. Bye for now.